Here is a figure that surprises most people. The City of London still handles roughly 40% of global foreign exchange trading, more than any single Eurozone city, despite Britain leaving the European Union over 6 years ago. So if the UK walked away from the bloc, why does it still sit at the very center of European money? The truth is that the financial relationship between the EU and the UK is far more complicated than a simple split. They share a continent, a history, and deeply tangled markets, yet they now run on different currencies, different rulebooks, and different priorities. In the next few minutes we'll cut through the noise and lay out the real, concrete financial differences between the European Union and the United Kingdom as they stand in June 2026, the currency, the banking, the tax, the regulation, and the trade. No jargon, just the facts that actually matter. The most obvious difference is the money itself. The United Kingdom uses the pound sterling, controlled by the Bank of England from its base on Threadneedle Street. The Eurozone, that's 20 of the 27 EU member states, uses the euro, managed by the European Central Bank in Frankfurt. Crucially, not every EU country uses the euro. Nations like Poland, Sweden, and Denmark keep their own currencies. This matters enormously for monetary policy. The Bank of England sets interest rates purely for Britain's economy, so it can move quickly when UK inflation or growth demands it. The European Central Bank, by contrast, must set one single rate for 20 very different economies, from powerhouse Germany to smaller members like Greece and Slovenia. That's why a one-size-fits-all rate is one of the Eurozone's biggest structural challenges, while the UK's freedom to act alone is one of sterling's defining features. Before Brexit, a bank licensed in London could sell its services freely across all EU countries using something called financial passporting. That single permission unlocked the entire European market. Since the UK left the single market, that passport is gone. Today, UK-based banks and asset managers must rely on a patchwork of separate national licenses or so-called equivalence decisions, which Brussels can grant or withdraw at will. The practical result is visible. Major firms such as JP Morgan, Bank of America and Goldman Sachs have shifted hundreds of billions of euros in assets and thousands of jobs to hubs like Dublin, Paris, Frankfurt, and Amsterdam to keep serving EU clients. Amsterdam even overtook London for a period as Europe's largest share trading center. London remains dominant overall, but the easy, frictionless access of the past has been replaced by duplication, extra cost, and constant regulatory negotiation. When Britain was a member, it followed EU financial regulation directly. Now the two are slowly pulling apart, and this divergence is the story to watch. The European Union tends to favor broad, harmonized rules designed to fit every member state, covering everything from capital requirements to sustainability reporting under frameworks like MiFID and the wider EU rulebook. The UK, meanwhile, has launched its own reform drive, often nicknamed the Edinburgh Reforms, aiming to make London more competitive by tailoring rules to its own market, easing certain banking restrictions and streamlining listing requirements to attract more companies to float on the London Stock Exchange. Neither approach is automatically better. The EU prioritizes stability and uniformity across a huge bloc. The UK is betting on agility and lighter touch rules to win business. But for any company operating in both, it now means following two separate and slowly diverging sets of paperwork. Tax is where individuals and businesses feel the difference most directly. The European Union does not set income tax, that stays with each national government, but it does coordinate value-added tax, with a minimum standard VAT rate of 15% across the bloc. The UK sets its own VAT at 20% and is no longer bound by EU rules, giving it freedom to create exemptions or zero-rated goods as it chooses. Corporation tax also varies wildly. Ireland famously attracts multinationals with a headline rate around 12.5%, while the UK's main corporation tax rate sits at 25%. There's also the question of trade taxes. Goods moving between Britain and the EU now face customs declarations and potential checks, something that simply didn't exist when the UK was inside the single market and customs union. The EU remains the UK's single biggest trading partner, accounting for roughly 40% of British exports, so the two economies are still deeply linked. but the terms have changed. Under the Trade and Cooperation Agreement, goods can move tariff-free if they meet rules of origin requirements, yet services, which make up around 80% of the UK economy, have far less guaranteed access. For investors, this creates a clear split. The EU offers access to a single market of roughly 450 million people under one broad framework. The UK offers a deep, English-speaking capital market, world-leading legal services and the flexibility of an independent regulator. Many global firms now deliberately keep a foot in both camps, running an EU entity and a separate UK entity, precisely because the two financial systems no longer flow seamlessly into one another. These differences reach right down to your bank account. In the UK, deposits are protected up to £85,000 per person, per institution, through the Financial Services Compensation Scheme. Across the EU, the equivalent guarantee covers deposits up to €100,000 under harmonised deposit insurance rules. Payments differ too. The EU SEPA system makes euro transfers between member states cheap and standardised, while UK payments run on domestic systems like faster payments. Even card fees and roaming charges shifted after Brexit, because the UK is no longer covered by EU caps on cross-border charges. For ordinary savers, travelers, and online shoppers, these are small but real reminders that you are now dealing with two separate financial regimes rather than one unified European system. So what's the real takeaway? The EU and the UK are no longer one financial system but two neighbours running in parallel, sometimes cooperating, sometimes competing. The euro means shared monetary policy across 20 nations, while sterling gives the UK independence to act alone. The EU offers vast unified market access and harmonised rules. The UK offers regulatory agility and a globally dominant financial centre that, even now, punches far above its size. Tax, banking access, trade terms, and consumer protections all differ in ways that affect businesses and individuals every single day. If you remember just one thing, make it this: Brexit didn't sever the money, it duplicated it. Understanding which system applies to you is now an essential part of doing business or investing across Europe. Thanks for watching, and do explore the channel for more clear breakdowns of the topics that shape your money.